When Warren Buffett was just 25 years old, he started his very first investing firm. He called it Buffett Partnership. This investing company existed from 1957 to 1969, and in its time, Buffett achieved an average return of 29.5%. The exciting thing about the method Warren Buffett invests in is that he uses very simple approach for investing to achieve these high returns. Hello friends, welcome to our channel. If you want to watch this kind of video, press the subscribe button and hit the bell icon. If this video seems helpful, like it and share it with others. If you have any concerns or tips about it, leave a comment down below. Now let's get started. As Buffett states, you don't need to be a rocket scientist. Investing is not a game with the guy with 160 IQ beats the guy with a 130 IQ. Rationality is essential. So, the key to achieving high returns is being rational and following simple strategies and sticking to them when times get challenging. What I want to do in this video is to show you 7 investing rules that Buffett is utilized to achieve such a high return. However, I'm not saying that you are going to achieve a return as high as Buffett's. I mean, he has dedicated his life to investing and he is a wise man. If you can follow these 7 investing rules from Warren Buffett, it will significantly help your overall long-term return. Rule number 1. If the business does well, the stock eventually follows. This was a rule that Warren Buffett learned when he first picked up among the greatest investing books of all time, The Intelligent Investor by Benjamin Graham, who later on became Buffett's mentor. Now, among the rules taught in the book was, in fact, extremely simple. The rule convinced Buffett that when you own a stock, you own a piece of a company. Over the long term, if their business does well, the stock will also do well. So, find the companies that will dominate in the future, ones that make a high earnings margin, ones they are ahead of the competition, one their consumers love. You don't require a complicated guy stock as part of the business, and if their business does well, you will undoubtedly do well. Rule number 2. Most news is noise, not news. This may be considered an unpopular opinion from Buffett, but most news that consume is not essential when it comes to investing. You see news programs like CNBC, news websites, the financial YouTubers. They are all paid to get as many views as possible. So what they do, they produce as much hype or tension, they produce as much news as they potentially can to get those views, so that they can get paid much more. You truly only need to take notice of about 5% of that news. However, as Buffett says, owners of stocks frequently let their unpredictable and often irrational behavior of their fellow owners to cause them to behave irrationally because there is many chatter about markets, the economic rate of interest, the price behavior stocks, and so on. Some investors believe it's essential to listen to pundits and even oversee it. Important to consider acting upon their comments. Don't stress over the pundits, and also don't worry about most of the news. Pay attention to the key and also essential details, and that's it. Rule number 3. When you buy a stock, plan to hold it forever. Now, I hope this is a financial principle that you have been taught before. Compound interest is powerful. When you get dividend or capital gains and let that compound on itself and grow like a snowball, you can make a lot of money. Yet, if you are constantly buying and selling stocks, you are not letting compound interest do its thing, and also you will miss out on plenty of returns, just like the blue line. That's why they say it's all about time in the markets, not timing the market. So, the key with investing is, when you invest in a stock, you must plan on owning a better quality business forever. You recognize that's why Buffett has owned stocks like Coca-Cola, Wells Fargo, as well as American Express for over 25 years. As the Grateful Fisher states, if the stock has been correctly done when a common stock is purchased, the time to sell is almost never. Rule number 4. Only listen to those you know and trust. Now, the fantastic thing about investing is when not in this alone. Even Warren Buffett, throughout his investing career, has always been learning and listening to other investors. When he was younger, he had the investing mentor Benjamin Graham, who showed him the roads of investing. When he got a bit older, he always had Charlie Munger and his side to see if he had the correct viewpoint on things. Also, the lucky thing for us is that we have got fantastic investors to listen to and learn from. Undoubtedly Warren Buffett, as we can see the exact stocks that he buys every year and also his overall portfolio. Currently, Ray Dalio often views CNBC as expressing his opinion on things, same with Charlie Munger. However, the secret is we have to listen to those that we know as well as trust. Do we have to listen to that pundit who is always braving about the current hype on CNBC, or the new YouTuber getting many views discussing owning Tesla stock? Do they understand investing? Do they know the intrinsic value of each stock? Only listen to those you know and trust. Rule number 5. Understand what you are investing in. Risk comes from not knowing what you are doing. This is an extremely simple rule, yet one in which not many people follow and understand the company you are investing in. If we have a look at Warren Buffett's portfolio, you will notice that a lot of companies that he owns are extremely simple. You have got the company Coca-Cola. They sell soft drinks and have increased their business to food. Southwest Airlines is a plane company that makes money by selling flights. Furniture Mart sells furniture. Apple sells iPhones and various other technology. Warren Buffett makes sure that before he buys a stock, he is capable of understanding the company. You must do the same. If you are into cars, look deeper and so Ford, Toyota, Tesla. If you're interested in e-commerce, Amazon and Alibaba. If you like the online world, look like companies like Alphabet that owns Google and YouTube. For pretty much every different passion or interest, there are stocks out there to be bought. Only buy those companies that you are capable of understanding. Rule number 6. Be fearful when others are greedy and greedy when others are fearful. This is a rule that is particularly relevant to today's market conditions. You see, the thing about this exciting market condition is we have had a bull market for about 11 years now. Stocks have gone up over 300%. Everybody thinks that they are genius when it comes to the stock market because every little thing is been rising and everybody is making money. This leads to one obvious thing. Everyone becomes greedy because they are overconfident and also their investing skills. Now, what do you believe this does to stock prices? Well, it overinflates prices. Every person wants to invest. Stock prices go higher, making it harder and harder each day to discover a deal in the stock market. These are times when we need to be fearful as well as careful with our financial investments. As well as this is exactly what Buffett is doing. He has $214 billion in publicly traded stocks and $128 billion in cash. That's a lot of money in cash. Currently, he is utilizing a very careful method in this market condition. You might state he has been scared, but you can bet your bottom dollar that as quickly as panic starts to set in with the stock market, Warren Buffett's greed will undoubtedly kick in, as well as he will certainly be snapping up a lot of stocks when they are on sale. Rule number 7. Buy at a price below intrinsic value. If you don't follow this rule when it involves investing, all of the various other rules go out the window and your investing method will undoubtedly be useless. No matter just how good the company, no matter how good managers are, no matter how much you understand the company, it's not thought an infinite price. Also, you need to make sure that the price you are buying for is below or at intrinsic value. Let me discuss this a bit more clearly. Let's say you are looking at buying a Lamborghini. There is no doubt in any person's mind that this is a solid, fantastic quality car. There is no doubt that the manufacturers took great care and appreciation when developing this car. However, the one question you need to ask, is it worth its price tag? Is it worth that $350,000? Remember, no car is worth an infinite cost, and it's the same with the business flash stock. That's why Warren Buffett states no company, no matter how wonderful, is worth an infinite price. Price is what you pay and value is what you get. Nevertheless, I would say the 7 rules are quite integral. When it comes to investing, you need to correct mindset of knowing that a stock there is a part of the business. If their business does well, you will do well. Most news from those financial TV programs and most YouTubers is noise, not news. When you buy a stock, the best holding period is forever. Never buy a company you can't understand. Be fearful when everyone is greedy and greedy when others are fearful. Of course, only buy a stock at a price that makes sense. Follow these 7 essential rules and you will beat most investors. That's it for today's video. Let me know in the comments below whether you get value out of this video. If you enjoyed this video, click the subscribe button and turn on the notification bell. If this video seems helpful to you, like it and share it with your family and friends. Thanks for watching, and I will see you in the next one.